everyone, welcome to our module on trading theories. A good metaphor would be that we've started with the ABCs, candlesticks, moved on to the sentences when we looked at patterns and indicators. Now, as we move on to trading theories, it's time to look at the chapters.
Okay, so what is a trading theory then?
A trading theory is an explanation of how markets behave. Most theories seek to predict and explain participant psychology and future price movements to some degree. If a trader knows how a market reacts to certain scenarios, the probabilities can shift in their favor.
Sounds interesting.
Yes, trading theories can be fascinating. It's important to note that theories are not trading strategies or indicators or analysis types, like technical or fundamental. Theories normally cover all types of freely traded markets, from shares through to FX, commodities and debt.
Right, that's good to know. I'm looking forward to getting started.
Let's kick things off by looking at how we use trading theories. All serious traders, even very short-term ones, need to subscribe to a comprehensive view of how a market works.
Right, why is that then?
Well, every style of trading has conditions that must be met for it to be successful. It was widely believed that the age-old 80-20 rule applied to trading, insofar as 80% of the moves happened in 20% of the time. This has been looked at more scientifically by hedge fund manager Mark Boucher, and his research says 70% of a market's moves occur in 20% of the time. As we know, traders should seek out opportunities and strategies where the probabilities are in their favor. Having a broad appreciation of how a market works and what phase it's in helps a trader in this regard. It's usually the first layer of analysis a good technical trader does before arriving at a trading decision.
Can you give me an example?
Yes, if the theory anticipated a long-term bear market, do you think the odds are likely to be in a trader's favor if the strategy they were using meant they kept going long?
No, not really. Common sense says not. It's a bit like swimming against the tide.
You're getting it. This concept will become apparent as we work through the theories.
So, what specific theories are we looking at in this lesson then?
Well, there are lots of theories out there. Some have built on one another and stood the test of time. Others have been completely disproven, despite having a few passionate followers. Each one is probably a course in its own right, so we are only going to introduce them here.
Sounds like there's a lot to learn.
It shouldn't take too long to cover the basics, but of course, as with all aspects of trading, there is always more you can learn. So, first of all, we are going to introduce two well-subscribed theories, Dow theory and Elliott wave, and tell you why we don't use them.
Did you just say we don't use them?
Yes, that's right. So a good trader needs to be aware of other theories because, as we know, a lot of price action is self-fulfilling. We'll try to cover these two fairly quickly in the next two videos. There are also aspects of each theory that are useful in a practical sense. The final part of this lesson concerns itself with introducing the 4 market stages. This is the theory we subscribe to and build on in our strategic training course. We'll provide an introduction to it at this stage.